Three major economic forces are colliding on October 29th when the Bank of Canada announces its rate decision. First, GDP growth has slowed to 1.2%, demanding lower rates. Second, core inflation refuses to drop below 2.6%, demanding higher rates. Third, unemployment at 6.9% sits in the middle, not bad enough to panic, but not good enough to celebrate. This economic tug-of-war is why RBC and other major banks expect a cut from the current 2.75% down to 2.25%. This might be the most important rate decision in years. It's not just about what happens in October, it's about setting up the entire trajectory for 2026. The bank faces a choice between two bad options, and the data behind that choice tells a story Governor Macklem would rather keep quiet. Hi, I am Kane. I own properties throughout Ontario. Be sure to watch my biography video to learn more about my story. Please see the description below for the references on where I pulled this information from. Let me know if you find any errors. Without further ado, let's begin. The numbers tell a story that Governor Macklem doesn't want to admit publicly. Canada's economy sits stuck between two bad options. Cut rates too fast and inflation stays high. Cut rates too slow and unemployment rises. The economic data forced the bank back into cutting mode in September after earlier attempts to stabilize rates. GDP growth at 1.2% means businesses are barely expanding. When companies grow that slowly, they stop hiring new workers. They delay buying new equipment. They wait on new projects. This is what happens when an economy loses momentum. The Bank of Canada knows this number signals trouble ahead. Unemployment at 6.9% sits in an uncomfortable middle ground. It's not a crisis like we saw during COVID, but it's not healthy either. We're half a percentage point above last year's levels. That means more Canadians are looking for work but can't find jobs. The September jobs report showed 6,400 new positions, but Governor Macklem warned against reading too much into 1 month's data. The economy had lost over 100,000 jobs in July and August combined. Core inflation at 2.6% creates the bank's biggest headache. It's still above the 2% target, but it's been falling for months. The bank faces criticism no matter what they choose. Business leaders want lower rates to boost growth, but economists worry about inflation staying too high for too long. Governor Macklem emphasized the need for humility in forecasting, acknowledging significant uncertainties from trade disputes and evolving productivity dynamics. This cautious approach reflects the complex balancing act the bank faces when economic data presents conflicting signals. Consumer spending stayed weak throughout the year. Business investment remained low. Housing activity slowed down even more. The economic data left the bank with little choice but to resume rate cuts in September after holding at 2.75%. Other central banks are cutting rates too, putting more pressure on Canada. The Federal Reserve is lowering rates to support the U.S. economy. When major central banks cut rates together, it creates capital flows between countries. Canada can't ignore what other central banks are doing. If Canadian rates stay too high compared to U.S. rates, it affects the dollar and trade. The bank faces constant criticism from different groups. Real estate agents want lower rates to boost home sales. Manufacturing companies want cheaper borrowing costs to expand production. But inflation specialists worry that cutting rates too fast will make prices rise again. Governor Macklem has to balance all these competing demands while keeping inflation near 2%. Trade uncertainty makes the bank's job harder. The upcoming review of the Canada-US-Mexico agreement creates more unpredictability. Businesses told the bank that ongoing uncertainty stops them from investing and hiring. Some companies are waiting to see what happens with trade policies before making big decisions. The artificial intelligence sector provides one bright spot. AI companies are investing in Canada and boosting productivity in some industries. Governor Macklem noted AI's potential as an important tailwind for the economy, but this growth isn't enough to offset weakness in other parts of the market. The bank needs broader economic improvement, not just growth in a few sectors. A 25 basis point cut from 2.75% to 2.50% represents the compromise that buys time while supporting the economy. It's not aggressive enough to worry about inflation increase, but it's not so cautious that it ignores the economic slowdown. This middle path gives the bank room to watch what happens next. The International Monetary Fund warns that Canada's progress on lowering inflation could stall if energy costs rise again. Oil and gas prices affect inflation directly through higher fuel costs. They also affect it indirectly when transportation and heating costs go up. The bank has to consider these external factors when setting rates. Population growth has slowed down, reducing pressure on housing and jobs, but it also means less economic growth from new workers and consumers. The bank has to factor in these demographic changes when forecasting future economic conditions. The October 29th decision will determine whether rates drop to 2.25% or hold steady. Either way, the real impact comes down to what this means for your monthly payments and borrowing costs. Here's the math most people get wrong when rates drop. A 25 basis point cut sounds small, but the impact on your payments is immediate. The Bank of Canada's decision affects different types of borrowers in different ways. You need to know which category you fall into and what it means for your monthly payments. Variable rate mortgage holders will see their prime rate drop from 4.95% to 4.70%. The exact savings depend on your mortgage balance and remaining term, but any reduction in your interest rate means more of your payment goes toward principal instead of interest. The larger your mortgage balance, the more you save each month. But here's the catch that most people don't understand. Your monthly payment might stay the same while more goes to principal. Many lenders keep your payment amount fixed when rates drop. The extra money that used to go to interest now pays down your mortgage balance faster. This builds equity quicker, but doesn't help with monthly cash flow. You need to call your lender and ask them to reduce your payment amount if you want the immediate savings. Some variable rate mortgages have payment amounts that adjust automatically. With these mortgages, your payment drops right away when rates fall. You get the immediate relief in your monthly budget. Check your mortgage documents to see which type you have. Fixed rate borrowers won't see immediate relief, but renewal rates are getting better. If you're locked into a fixed rate mortgage, the October rate cut won't change your current payments. Your rate stays the same until renewal time. But when you do renew, the rates available will be lower than they were 6 months ago. Bond yields at 2.6% mean fixed mortgage rates won't drop as fast as variable rates. Fixed mortgage rates follow government bond yields more than the Bank of Canada rate. The 5-year government bond yield sits around 2.6% right now. Lenders add about 1.5% to 2% on top of that for their profit margin. This means 5-year fixed rates stay around 4.1% to 4.6% even after rate cuts. The 5-year fixed rate is only down 0.04% even with multiple rate cuts this year. The Bank of Canada has cut rates 3 times since June, but fixed rates barely moved. This happens because bond markets price in future rate cuts before they happen. When everyone expects rate cuts, bond yields drop early. Then when the cuts actually happen, fixed rates don't fall much more. For investors, mortgage investment corporations will see compressed yields but higher demand. MICs earn money by lending at higher rates than they pay investors. When the Bank of Canada cuts rates, MICs can charge lower rates to borrowers, but they also pay less to their investors. The spread between what they earn and what they pay might stay similar. Lower rates create more demand for borrowing. People who couldn't qualify for mortgages at 5.5% might qualify at 4.5%. Property investors who put deals on hold might move forward with purchases. This increased lending volume can offset some of the margin compression for MICs. Private lenders face similar dynamics. They typically charge 8% to 12% for short-term loans. When bank rates drop, some borrowers might qualify for bank financing instead of private loans, but private lenders can also lower their rates slightly while maintaining good profit. Variable rate debt becomes cheaper immediately, while fixed rate savings take longer to materialize. If you have variable rate loans, credit lines, or mortgages, you benefit right away. The prime rate drops within days of the Bank of Canada announcement. Your next payment reflects the lower rate. Fixed rate debt holders need patience. Your current payments stay the same, but future borrowing costs less. When you renew your mortgage or take out new loans, you access the lower rates. The timing of when you benefit depends on when your current terms expire. The immediate impact on your payments is just the beginning. What happens after 2.25% depends on economic forces that could keep rates steady for longer than most people expect. Bank forecasts for 2026 show mixed predictions that create planning challenges for investors. RBC expects rates to hold around 2.25% through 2026. TD expects gradual cuts to reach 2.25% by mid-2025. BMO expects 3 cuts, bringing rates down to 2.00%. Other major banks have varying forecasts between these positions. This disagreement among experts means you need to prepare for multiple scenarios rather than counting on one outcome. This extended period around current levels isn't about the economy being perfect, it's about waiting to see what happens next. The Bank of Canada needs time to watch inflation trends and economic growth. They want to see if their rate cuts work without pushing inflation too high. A pause gives them data to make better decisions later. If core inflation drops quickly to 2%, the bank might cut further to 2.0%. Right now, core inflation sits at 2.6%. It needs to fall another 0.6% for the bank to feel comfortable cutting more. This could happen if energy prices stay low and wage growth slows down. Lower inflation gives the bank room to support the economy with cheaper borrowing costs. If inflation stays stubborn above 2.5%, rates could rise again by late 2026. The bank has a 2% inflation target. They won't let inflation stay high for too long. If prices keep rising faster than 2.5%, the bank will likely raise rates even if it hurts economic growth. They learned this lesson during the high inflation period of 2021 and 2022. The IMF warns that energy price rebounds could derail Canada's disinflation progress. Oil and gas prices affect everything from transportation to heating costs. When energy gets expensive, it pushes up prices across the economy. Canada exports a lot of energy, but we also use a lot of energy too. Higher energy prices create inflation pressure that's hard to control. Trade tensions and tariff policies from the US could push inflation higher unexpectedly. If the US puts tariffs on Canadian goods, it makes our exports more expensive. This can lead to retaliatory tariffs that make imports more costly for Canadians. Higher import costs show up as inflation in grocery stores and retail shops. Governor Macklem emphasized being humble in forecasting because of these uncertainties. The Bank of Canada got inflation forecasts wrong before. In 2021, they said inflation would be temporary. It stayed high for much longer than expected. Now they're more careful about making predictions. They know external factors can change their plans quickly. Supply chain disruptions remain a risk for inflation. Even small problems with shipping or manufacturing can push prices higher. The bank watches global supply chains closely. They know that problems in other countries can affect Canadian prices. This makes forecasting inflation much harder than it used to be. Smart investors are preparing for both scenarios. Some are locking in fixed rates now while they're still relatively low. Others are staying with variable rates to benefit from potential future cuts. The best strategy depends on your risk tolerance and financial situation. Real estate investors need to think differently during this period. You can't count on rates dropping much more. Your investment returns need to work at current rate levels. Property cash flow calculations should assume rates stay around 2.25% to 3% for the next 2 years. For mortgage investment corporations, this period offers stability. MIC managers can plan their lending strategies, knowing rates won't change dramatically. This helps them maintain steady returns for investors, but they also need to watch for signs that conditions might change early. The extended pause gives you time to lock in variable rate savings while keeping refinancing options open. If you have variable rate debt, you benefit from the October cut right away. Don't count on much more relief in 2026. Your strategy depends on reading the inflation signals correctly. Watch the monthly inflation reports that come out. Pay attention to energy prices and wage growth numbers. These indicators will tell you if rates might move up or down when conditions change. The October 29th announcement sets the stage for navigating this complex environment. This rate cut from 2.75% to 2.25% represents 50 basis points of relief, making it more significant than typical quarter-point adjustments. You need to watch core inflation monthly releases and GDP growth reports to predict when the 2026 pause might end. Your next mortgage decision should account for both the immediate benefits of reaching 2.25% and the possibility of rates moving in either direction by late 2026. If you have variable rate debt, you benefit now, but prepare for rates to stay flat for months. Fixed rate borrowers should consider locking in current rates before the economic data changes the bank's strategy again. If you enjoyed watching this content, be sure to check out where you stand on the pay scale. What do the rich invest in and how they think?